So let's first start talking about day trading and what day trading is, because a lot of people have it confused or have it a little bit mixed up. Day traders are different from investors in that day traders hold their securities for only one day. They close out their position at the end of every day and then start all over again the next day. By contrast, swing traders hold securities for days and sometimes even months. And investors sometimes hold for years. Now, this gets a little bit confusing because most people or most traders assume when you're trading CFDs, as contracts for difference, that they end at the end of the day, but that's not true. A CFD can continue forward day after day after day. A CFD actually doesn't have a end or termination date, although most traders, CFDs are designed to be traded in very short term. And so they are short-term instruments, but they are not only day trading because you can leave them open overnight, where a day trader does not keep any position open overnight. In other words, they go to sleep at night with no worries. But it can be very stressing during the day. The short-term nature of day trading reduces some risk because there's no chance of something happening overnight to cause big losses. Meanwhile, many investors have gone to bed thinking their positions is in great shape and then woke up only to find out the company has now terrible earnings or that its CEO is indicted on fraud charges. But there is a flip side. The day trader's choice of securities and positions has to work out in a day or it's gone. Okay, so that puts a very finite time element on what you're doing. Now, that's only if you want to use the hardcore rules of being a day trader. Okay? But the fact is, when you want to consider yourself a day trader or short-term trader, and you're trading with CFDs, if the asset hasn't swung in your favor or is moving a little bit slower in the direction you thought it was, you can leave it open. So you can take the very specific definition of a day trader, or you can expand it. Now, it used to be, before we had CFD trading, that you had to set up a day trading account with a broker, and therefore he maintained the rules. But that doesn't happen anymore. So technically, there's no tomorrow for any specific position. Meanwhile, the swing trader or the investor has the luxury of time, as it sometimes takes a while for a position to work out the way your research shows it should. In the long term, markets are efficient and price reflects all information about a security. Unfortunately, it can take a few days for short runs for this efficiency to kick in. Now, when you take up day trading, the rules that may have helped you pick good stocks or find great mutual funds over the years don't apply. This is a very different game with different rules. So CFD trading is quite unique because you can buy and sell. So you can sell short and buy long, but because you're looking for short-term moves and you're not looking for a swing trader who's looking for something to move and make money over 3 months. You're looking for something to make money over hopefully 3 hours. So you have to apply different rules, different strategies, and a different mindset. Day trading is a crazy business. Traders work in front of their computer screens reacting to blips, each of which represents real dollars. They make quick decisions because their ability to make money depends on successfully executing a large number of trades that generate small profits. Because they close out their positions in the stocks, options, future contracts they own at the end of the day, some of the risks are limited. Each day is a new day, and nothing can happen overnight to disturb an existing profit position. Now, this is one of the most important definitions of a day trader. A day trader is looking to make small profits, not let his asset run. They're looking to make, they're a hit and run, hit and run, hit and run. They would like to make a lot of trades. So when you talk about me, I don't call myself a day trader because I do a lot of swing trading. But so I call myself a short-term trader. But it takes me 4 days basically to execute 10 trades, short-term trades, because I'm slow and methodical. So I don't fall into that category of a day trader. Okay. So you have to define what the difference is. But those limits on risk can limit profits as well. After all, a lot can happen in a year, increasing the likelihood that your trade idea will work out. But in a day, you have to be patient and work fast. Some days there's nothing good to buy. Other days, it seems like every trade loses money. Do you have the fortitude to face the market every morning? Okay. Now, with day trading, what we're looking for at all times is volatility and momentum, because assets that aren't moving don't do you any good. Okay, so you need assets that are either trending up or trending down or bouncing all over the place, because in order to make those short-term trade profits and in order to be a day trader, so you're closing out your trades at the end of the day, you've got to have that movement and momentum, because otherwise, yes, you may say the euro is going to go up 15 pips, but if it doesn't happen for 3 days, well, you still were completely right and went where you went. You need that 15 pips in an hour. So each trading day is different. Traders won't find 2 days in the market that are exactly alike. Yet even though each day isn't exactly alike, there are still patterns that tend to occur over and over, hidden within the seemingly random daily price movements. So now, one of the important things about day traders is day traders have to be able to chart, look at charts, and react extremely quickly. So you have to have a trading method that's not overly complicated, because you don't have the luxury of time of sitting back and saying, oh, okay, this happens, that happens, this is going to happen, that's because you've got to take advantage of the move. Day trading was originally only available to financial companies because they had access to exchanges and market data. Okay, and this is where the big change came. When we got online trading, and even in the beginning of online trading, everything wasn't being fed back and forth fast enough. Okay, and not the platforms, the trade execution, the liquidity providers, but even the financial data, like all the economic events, all the news did happen. But as the internet got faster and faster, and the data was more available, and we had scanners, and we had, we could set up our whole trading strategy based on, what we, whatever we're going to use, whether you're using MACD and the charts, we could just drop it on the charts and it's instantly there. You're not hand charting or hand calculating or putting it all together, putting it all down by man. Day trading became available to everybody. And if you remember right, in the 60s and the 90s, you started hearing about all these secretaries and God knows who, office workers and everybody else, bartenders, who are getting rich day trading and spending the rest of the day on the beach, trading, getting rich, and see Mercedes and Rolls Royces in the advertising. Well, all that was a crock. It was hype. Okay. But day trading's matured and become a legitimate part of trading, but it is work. It's not going to make you rich overnight. It's not easy. But because we have access to everything, we now have the ability to compete with the big boys. But this is where we come. Now we come up to trading styles and then strategies. There are several different styles for day trading suited to different day trader personalities. The styles range from short-term trading, such as scalping, where positions are only held a few seconds or minutes, to longer-term swing or position trading, where a position is held throughout the trading day. Now, let's stick to the basics. Day trading versus swing trading. Okay. Swing trading in a day trading style means you would open your position and, or a day swing trader, right? Basically, is somebody who would open a position earlier in the morning and let it ride all day because they expect the euro to climb 15 or 20 pips throughout the day, and they would close out. On the other hand, you have very short-term day traders who are making many, many quick trades, and they want to open a trade now and close it a few minutes later. So they want to flip the minute that asset hits a resistance level and bounce up. They want to enter the market. The minute it hits that support level, they want to be closing. So many traders, day traders, will have trade multiple styles, but most traders will choose a single style and only take that particular type of trade. Now, day trading also has different types of trades, such as trend trades, counter trend trades, ranging trades. Trend trades are trades in the direction of the current price movement. In other words, following the strategy, the trend is your friend. And then counter trend moves, which are trades against the direction of the current trend. Now, these counter trend moves are like when an asset is moving up. Let me just get my marker on here. Okay, so when an asset is moving up, an asset doesn't move this way. An asset retraces. It push and ease, push and ease, push and ease. Push. A counter trend trader, okay, a trend trader looks to trade this direction. A counter trend trader looks to enter at the top of the ease to take advantage of that move down before it bounces back up to follow that trend. And then the range trader is looking for an asset that is trading in a very predetermined sideways pattern, and he can buy at when it bounces off of resistance, sell when it comes to support, and bounces up and down, up and down, up and down. So these are three of the basic type trades. The assets, an asset can only be moving up, down, or sideways. So range traders are traders that go back and forth between two prices and are used when the market is moving sideways. Most day traders will choose a single type of trade, but some traders will take different types and choose one which one to trade depending on the current condition of the market. And overall, that's about the best thing that you can do, because every day the market is different. Some days you have assets that are trending. Some days you don't. Everything's moving sideways. Or some hours of the day. Like once you've had, the U.S. data release, basically the U.S. markets at that point, not the markets, but the commodities and Forex basically range trade until the Asian markets start, moving up, unless it's earnings reports coming out or there's headline news coming out. But otherwise, they're trading in ranges sideways. Okay, so you have to have a style for each type of day and each type of market, and then evaluate the day. In addition to style and type of day trading, there are some other variances between day traders. Some day traders like to make many trades throughout the trading day, while others prefer to wait for what they consider the best conditions for their trade, and perhaps only make one trade per day. However, many trades are made, and the trading process that is used and the desired goal of making profit are the same. There's scanners. So if you're just looking to trade with the trend, or you can very quickly find all the assets that are trending up or that have momentum, and then just simply trade those assets, because you don't need the history of the asset. You don't need to know the Federal Reserve might do this next week, and Donald Trump did that 3 days ago, and the stock market's doing well because the Federal Reserve said they're not going to raise rates. Okay, you're only concerned with what is happening at the moment. So you're looking at a position. Can I get in here, and is it going to bounce up to here? Not is it going to have something that's going to send Apple soaring $25. You only want Apple to bounce. If Apple's trading at $47 and it bounces down to $49.75 for a minute, you want to grab it $49.75 and sell it at $49.10 or $40.10. you make yourself your 25-cent profit, but you've used CFDs to trade the stocks, you've used leverage, and you've ranked yourself up, and you're out of that in just a few minutes. Now, there are many different financial instruments or markets that can be traded, and they offer various exchanges throughout the world. The main types of day trading markets are futures, options, currencies, and stock markets. Now, this changed radically because you can trade with an options broker and day trade. But today, almost everybody does the day trading in CFD format. Now, I forgot to mention at the beginning of the class, if you notice, I prepared two handouts for you. One is called a day trading guide, and the other is a momentum day trading strategy. Okay. The day trading guide kind of covers this class, and the momentum day trading strategy breaks out one of the most popular trading strategies for day trading. Now, you can only get these during the live class. So please click on the download button and download them to whatever device you're using, whether it's a handheld, a tablet, a PC, a laptop, because you won't have access to these any other time. They're not available during the recorded version, and there's nowhere to ask for them. So download them now, and then just move them around later to wherever you want. Now, within these types, there are groups of markets based on stock indices, currency exchange rates, commodities. Day traders can have access to all of their exchanges and their markets via a direct access broker or through a CFD provider like Alvexo. So first, let's be clear about what day trading isn't. It's not investing, which is the process of buying a stake in an asset that will hopefully build profit over a long term. How long is subjective, but investors generally hold assets for years, even decades, but at least for months. And those assets have value. Whether you're buying gold futures, you're buying stock. Again, day trading is more about, it fits perfectly with CFDs because a CFD is a contract for difference. You actually don't own anything. You have a contract with your broker to pay one price, whether it's a buy or sell, and do the opposite when you close your position, and you get the difference of the two contracts if you have it in the right direction. So if you sold and it went down, you can buy it back lower, you get the difference. Okay. If you're wrong, you lose the difference. So in between the two extremes, investing for years and trading for seconds, exist other investment horizons and other types of trading. Swing traders refer to holding a stake in a stock or commodity for several days. Position trading refers to holding a stake in a stock or commodity for several weeks or months. They all carry a certain amount of risk, but day trading is probably the riskiest and the most controversial. When we look at the history of day trading, we'll learn where the infamous reputation came from. Day trading is a relatively recent phenomenon, one made possible by several events and rulings throughout the past century. So in theory, anyone could become a Formula One race driver, but in reality, very few people possess the right skills or temperament for such a demanding sport. The same is true of day trading. Day traders must possess certain personality traits and have access to certain resources if they're to be successful. So, knowledge and experience in the markets. Day traders must have an understanding of market fundamentals if they're going to succeed. Most have many years of experience investing and trading in various markets. They also research constantly using services provided by full-service online brokerage accounts and information from publications like the Wall Street Journal to gauge market sentiment. Now, basic day trading rules are always respect the markets and do trade only with market direction. In other words, the trend is your friend. Never overtrade. Many traders lose money by leveraging too much. Now, CFDs are leveraged products and leverage is built in, but because you're dealing with a regulated provider, leverage is set by the regulator. Make sure, as a day trader, because you're trading in volatile markets with momentum, you always place a stop loss based on your risk management. Always watch trends for some time before doing a trade. And one of my favorite things I'm going to tell you is open a demo platform, practice for at least 30 or 60 days to do day trading before you actually make trades. Now, if you want to trade CFDs and use other strategies, fine. But day trading, because you're looking for those little blips, you're either looking, because the rules, it has to be closed by the end of the day if you set them. And most day trading strategies are looking for little, whether you're scalping or momentum trading or volatility, you're looking for little movements that happen quickly. And when you're looking at those little movements can happen quickly, they can also move in the other direction just as quickly. So don't give ear to rumors and fellow traders. Always do a little homework before doing trade and trade only in assets which you know. Always book profits as well as losses. Now, majority of the days, the markets will tend to range trade. Okay, so don't look to make profit every day. There are some days the markets just aren't offering any type of situation. What you want to do is only enter high probability trades, limiting them down to trades that you have that fit very specific rules, because you don't have the time of day trading to do all this type of analysis. Okay, the market is always right, and we can be the ones who are wrong. So always respect the market. It takes money to make money is a cliche that resonates with day traders. That's because they often borrow money called leverage to use in the market. While this is risky, it's absolutely necessary. Using a large amount of capital to make many small trades increases potential returns, but it also increases potential losses. Day trading is a business, and this is how you have to become a day trader. You have to think of it as a business, and as such requires a business plan. Most plans address short and long-term goals, target markets, trading hours, days, business setups, capital reinvestment, tax considerations, reporting, and other metrics, and analysis of each trade after the trade is over. Day traders separate themselves from their emotions and never act impulsively. It's one of the reasons I can't be a day trader. I even have a short-term. Being a short-term trader is even hard for me because I've never been able to put my emotions aside. No matter how much I teach you and lecture you about it, I'll see something going in my heart. It'll tell me it's going to do justice, and I'll bypass all of my rules. And of course, it goes against me. Now, 5 out of 10 might go in my favor, but 10 will go, the next 5 will go against me. So I netted out nothing. I might as well not have bothered. And that's the whole thing, is rooting down to only the high probability trades. Now, day trading functions through electronic communications networks. A trader accesses these networks using a computer and a high-speed connection. A typical setup might include 2 monitors working off one PC, a second clone to serve as a backup, all the stuff you need for trading. People who attempt to trade without these attributes, and so this means, number one, you need the most advanced charting services you can get, the most advanced platform you can get, because you're talking about trading and executing trades with small pips. You need to make sure you're dealing with a regulated provider, not because only for the safety of a regulated provider. A regulated provider must have 2 things. They must have multiple liquidity sources, and they must give you the best available price, because a broker or a platform doesn't actually conduct the trade. He's the middleman executing the trade for you. Okay. Well, it used to be if you wanted to execute a trade, they would give you whatever trade they actually got from the market. Now they're required to have a minimum of 3 liquidity providers who, when you go to do a trade, feeding them back to base. So you might try to enter the euro 112.19. You might find out you ended up buying it 112.18 because they were able to execute that trade at the best available price possible. So either way, it's a full-time occupation, or part-time day trading is possible but difficult. Those who adopt a part-time approach still treat their trading as a business. They set up a schedule, they follow it religiously. This discipline distinguishes them from hobbyists and those who experiment with day trading as a form of gambling. Day trading for beginners usually starts with research. They look out for different ways to improve their trading and dedicate a vast amount of time to search for the Holy Grail. The Holy Grail is what traders call a perfect indicator or a perfect trading system to provide setups with a 100% success rate. Even some experienced traders do it from time to time. Fortunately, perfect systems don't exist, and the only Holy Grail is proper risk management and money management. Fact is, you'd be very lucky to find any system that operates better than 50% of the time, 52, 54, 50, because what you're looking for is getting out of your losers with small losses, and your winners make you enough profit to cover those losers as well as giving you additional profit. Okay. So as long as your losses can be minimized by putting the proper stop losses. So if you have 10 trades and 7 of those were bad trades, they went against you and you got stopped out or closed out. If you only lost $50 per each trade, you're out $350. So the 3 that make profit, hopefully they each made $50 a piece or $100 a piece. So your net is a net profit. Okay. Because you're not going to find any system that is that accurate. Now, you want to develop strict trading plans and follow it strictly to manage your properly. There are many. You can have day trading chart patterns like triangles. A triangle is one of my favorite things to trade all the time. Because triangles will tell you that the market is reaching an apex. It's going to break out of a channel. Now, triangle, excuse me, don't give you market direction, but when you get the breakout of the channel, the triangle, that breakout generates momentum in the direction of the breakout. And that's one of the best strategies you can use is chart patterns. Okay. You'll have to be watching lots of triangles and watching for those breakouts, but they happen quite often. Now, keep an eye out for averaging down. Simply put, averaging down is keeping a losing trade open too long. To avoid it, cut losing trades in accordance with pre-planned exit strategies. Now, granted, you have a stop loss to protect you. A stop loss is your insurance policy. But the minute you see your trade not going in, doing what you expected it to do, don't wait to get stop loss. Close the thing out with the minimum amount of loss and get back into a trade that's doing what you think it's going to do. So what about stop loss? There are two kinds a day trader must consider using. A physical stop loss played at a level in accordance with risk tolerance, which you should know from your trading plan. Approximately 1 to 2% is a good level. Okay. Now, this is where traders get confused. And entry levels, risk and stop loss, and take profit levels are the most important thing. They're much more important than any strategy you're going to take. Now, when you look at the asset and you determine that a stop loss needs to be put here, where it's the proper place to put the stop loss, based on the movement of the asset, the volatility, and all the other calculations. But your risk, this is also the risk you're taking. So when you calculate what that risk is, and you go back to your risk management, that risk down here could be too high for your risk management strategy. So therefore, it stops you from making that trade because then you don't make the trade. Because every stop loss should fit 2 requirements. That number 1, it fits your risk management. Number 2, it fits the market movement. Because having to place a stop loss here when you're buying something, when you're buying it to go up and bounce down, well, that's not enough to cover the swing in the market. So you're going to get stopped out. You might as well not make that trade because you know you're going to get stopped out because that asset's moving up or down. And that's the swing it's going to take. Now, have you ever entered a market and watched the market make an unexpected turn and then suddenly realize that the trade is no good and it's time to cash out? That's a mental stop. The trick is not confusing it with just panic. That's why both physical and mental stops need to be thought through before entering a trade and not after. So that's what I was mentioning. You put your stop loss based on your risk management to stop you from getting too big of a loss. Your mental stop loss is when you look at it and say, uh-oh, that asset's not doing what I thought it was to do. So your mental stop loss is, okay, get out of the market, but you're not panicking. Okay, it's not a panic. Now, retail trade traders, specifically those who manage their own rather than somebody else's money, have another rule their stop losses must comply to. They set a maximum loss per day that they can withstand financially and mentally. Now, the other thing is stop losses are the most critical thing you can do. And to be a good day trader, you need to understand what a guaranteed stop loss is, what a trailing stop loss is, what a general stop loss is, how to put them, where to calculate them, and which one will work best for you. Understanding a trailing stop loss is a great thing for a day trader because a trailing stop loss keeps moving up as or down as the asset moves in your favor, and you can continue to lock in profit until eventually your stop loss is higher than your entry point. So even if the market turns against you, you got profit. There's other things like exit strategies or take profits. Like when the market moves in your direction, you can it makes you a couple pips. You can actually sell half of your holdings, put that money in the bank, and then move your stop loss up. And that way, if the market moves against you, you break even on that. And you still have the profit banked. So having an exit strategy, a stop loss strategy, these are what it's all about. Figuring out and then figuring out the price in which you're going to enter the market. Basically, you can at most times see an asset and say, that's a good, I'm going to trade that one to go up. And then it's calculating at what point you want to enter that market. Okay. These are more important than all of these convoluted trading strategies. These are risk management strategy, money management strategy, exit strategy. Now, the trend might be able to sustain itself longer than you can stay liquid. So let's consider volatility spikes mixed in with drops in liquidity. When news releases are due, traders should refrain from trading altogether unless there are specific market conditions. Now, one of the biggest problems that we have, and too many people like to trade the news, and the news can create great volatility, but the problem is when the news comes out and the market gets extremely volatile, there might be no liquidity to let you close out either at your stop loss or exactly at your take profit level. So there are certain ways you can deal with that. One of those is a guaranteed stop loss. That means that even if there's no liquidity, the broker guarantees that they'll close your trade exactly at that price. Because a stop loss doesn't mean you're going to get out exactly at that price. The computer will start generating, trying to get you out of the market. But a couple of years ago when the Swiss National Bank pulled the peg out of the Swissy and the whole market went haywire, even though you had a stop loss, you weren't getting out of the market because there was no liquidity. So the asset was dropping. Your broker got you out as soon as possible. But a broker, like I said, or a platform, is just a middleman. He's sending out that electronic signal to the liquidity provider. Liquidity provider has no liquidity and there's not any response. They're going to close you as soon as they can close your position. So the bottom line is, even if you somehow manage to know what the news will be, there's no way to predict how the market is going to react in the first couple hours. Bullish news can have bearish market jerks and vice versa. Eventually, the market will return to its trend, but until it does, the environment isn't that safe for day trading. Now, the bottom line is also keep in mind that a trader might not be able to protect his account with stops around news. If there is no liquidity in the market, the order won't close. It will continue sleeping until the first available counterparty is willing to trade. So remember, there's lots of things to think about. Figuring out what strategy, whether you're going to use a trend trading strategy, a momentum strategy, volatility, that only tells you, okay, yes, that tells me I should trade the euro. This is where I should set everything. But it's your risk management, your money management, your stop loss, and your exit point and your exit strategies that are more important. Because just because you figured out you should buy the euro and you're going to enter the market at 112.15 and you enter at 112.15. There's also understanding all the different order entry types. You need to know what a good to cancel is, what an OCO is, all the different types of order entries, what the difference between a limit order and a market order. Okay, how to set limit orders. Okay, how to determine what price you're going to set the limit order. Like I said, you need to know what an OCO is. You know, one cancels the other. It's a great way to trade because if you're not sure if the market's going to bounce up or bounce down, an OCO lets you place two orders ahead of time, and whichever way it goes is going to execute one and cancel the other. So all of these things you have to think about when you want to be a day trader. Okay, whether you're going to use Fibonacci levels and support and resistance levels, or you're going to use a MACD RSI combination, okay, or a MACD to trigger the entry and an RSI to tell you which direction, doesn't make a difference. Okay, because that's only giving you some information about when you what asset you want to trade or when you want to trade. The rest of it is the physical stuff that you're using to beat the market. That's it. So hopefully on that note, you've got some idea what to think about for day trading. Use the day trading guide, and it's got a full questionnaire in there for you about how to fill out all the things you want to do before you enter a trade and what your rules will be. And then the momentum day trading strategy, that handout will show you how to use momentum day trading step by step with examples and everything else so that you can become a day trader following one of the best strategies in the marketplace. So thank you very much. If you have any questions, just contact Elvexo at www.elvexo.com or go over their education platform, and you can watch videos, read ebooks, get guides, and everything else on day trading. Thank you very much, and have a great trading day. Bye now.